Welcome to this video about NewDeal Invest. My name is Mads Christiansen. I am the founder and CEO of NewDeal Invest. In this video, I will present to you our investment process and the theory behind it to help you better understand the jobs that our portfolios can do for you as an investor. I like to say that we do two jobs for our investors. The first job is to create a sharp tech portfolio with exposure to all the emerging trends in technology. In NewDeal Invest, where everybody is a tech specialist, and we spend our time focusing on trends within tech. We identify big and small trends, and then we find the leading companies within each of these technological trends, and we invest in them, thus creating a broad portfolio with exposure to trends like semiconductor, AI, cybersecurity, cloud compute, fintech, e-commerce, etc. The second job we do is very important as well. Investing in technology companies is very difficult, and it's very different from investing in other types of stocks, because tech and growth companies, they come with a high variance, and that is devastating returns in your portfolios if you do not do it in the correct way. And I'll get around that and explain the theory and some of the solutions to it that we apply. So to invest in NewDeal Invest, we have three platforms right now. We have the main fund, which is a registered IFE, alternative investment fund. It requires a minimum of 100,000 euros to invest there. Then we have the Nasdaq Copenhagen listed UCITS fund, which do not require any minimum investment. You can do that from your web bank. The ticker is PMI NDI, and the ISIN code is DK0062499801. And lastly, we have the eToro Corporation, where we're on the eToro platform now with the smart portfolio. And it's called ND Future Tech. So the rest of this video I'll use to explain first the opportunity that tech and growth stocks are to investors. Then I'll explain the problem, why they tend not to be such a good thing once we use the traditional investment process and put them into our portfolios. And third, I'll present the solution that NewDeal Invest offers. We have a two-layered solution that I'll explain to you. The opportunity you see here. Nasdaq is outperforming S&P 500. That's outperforming the DAX. DAX is an industry index. S&P 500 contains a lot of tech, like you know, but Nasdaq is even more techy. Companies can enter the Nasdaq way before they can enter the S&P 500. A company has to be so far in its path towards maturity that it's profitable before it can enter S&P 500, and it needs to have a certain size to make it relevant. In the Nasdaq, though you have more techy, growthy, younger technology companies, and that is probably the reason for the overperformance of Nasdaq. So you can do an index even more growthy and techy, and Bessemer Venture Partners Cloud Index is an example of that. And they've been around for 14 years and are yielding 22%, thoroughly outcompeting the Nasdaq. TDM Growth Partners wanted to test how would an index like that perform during the great financial crisis. So they made the GFC index here, the green line, and they saw that tech and growth outperformed from 2006 to 2013. They also saw that tech and growth really was hurt when the crisis came from a higher point and breaking down to the breaking all the way down. So really fast and furious decline, but then a huge outperformance coming out of the great financial crisis. And that is the same picture we see when we go back to the dot-com days. We've so far only seen the vicious fall that we had in 21 and 22 of techie growthy stocks. So our investors and I myself hope that we are somewhere around here and are ready to see this increase here. So an index like this is not a Max 7 index. So the rally we've just seen is mainly the big dominant tech companies that matters for indices, and we still have the rally for the next level of tech stocks, which is a little bit smaller than the really big tech stocks. So the NewDeal Invest Layer 1 strategy is that we do strategic analysis of technological trends and the companies operating within them. Then we pick what we call Bob companies. That's for best of breed. So the companies with the best technology, and we really want to invest in the biggest companies as well within each technological trend. We call them the gorillas. The big monkey in each technological segment is oftentimes the most interesting. So we invest in big companies. Then we do classical stock analysis. We do fundamental analysis, what's priced in by the market. We can see that in a DCF analysis, what kind of growth, what kind of margins would you have at maturity to justify the price that the market is currently giving this stock. And that helps us understand if we think it seems undervalued or overvalued. Then we do sentiment analysis as well. We like unpopular stocks. If we see a good technology and a good future for the stocks. We do technical analysis, and this classical stock analysis we use that to do weighting of the portfolio to actively manage this broad portfolio. And then we do assessment of future variance of the stocks. That is for the layer 2 process that I will get back to. So this layer 1 here, it really seems like an easy way to obtain the low-hanging fruits from doing tech investment in an index instead of doing it in a concentrated portfolio. So the question is, why are there these low-hanging fruits? Since we've seen that an index of younger, techier, growthier companies outperforms, then that must mean that these techie, growthy companies are undervalued compared to the expected future cash flows that these businesses will generate. And that begs the question, why are young, techie, and growthy companies so undervalued? And the answer to this is that variance results in poor real-life returns for tech investors, at least if you apply the wrong process. So the point here is that you cannot pay more than you could expect to get a return that justifies investing in this type of stock. And if you can get more from investing in another, then you'll have to take that choice. The problem is that the process that we use for investing in tech stocks probably is not nearly as good as it can be, and that's what we're solving in NewDeal Invest. But let's look at the problem first. There are 3 concepts that I'll explain to help understand the problem. It's a concept of variance, it's a concept of geometric returns, and the concept of non-ergodicity. Here we have a normal distribution. And what characterizes a normal distribution is that the median value here is also the average value. So the median value is if you have 500 people, the one that is number 500 in the middle of the pack, what's his height? That's the median value. The average value is we add up everybody's height, and then we divide by the number of people in the examination, and then we have the average value. And in a normal distribution, average and mean values are the same. So once we start investing through time in portfolios, we get a variance drag on the median results. And when you're investing through time, then what matters for you as an investor is the median results. You only live one life and you have one portfolio, so you're not interested in a result where you once in 1,000 lives get an astronomically large overperformance that helps you get a mean good performance in 1,000 lives, where you in the 999 lives are not underperforming. That's not valuable for you living one life. At least that's how I think, and that's how most people think. So what investors end up caring about is the median return that they will get. And what we see here in this examination or this simulation here is showing us that the median return falls when the variance increases. I'll not get into the details. You can read it up here, but here are the median returns when the variance is 0, and that's 35% in 5 years. And then if you increase the variance of the returns on the individual time periods and stocks, then you'll have a decreasing median return. And you'll actually get to a negative return, even though the average return here is 0.5%. Then if variance gets big, your median return, your most likely expected outcome is negative. And the point here is that once you invest in value stocks, you operate in a lower variance environment. But once you start investing in tech stocks, you operate in a high variance environment. And that means that the median results deteriorates. That means that the stock market has to compensate with lower prices on these assets. So if you could only mitigate the variance problem on these undervalued assets, then you could extract a really high return from them. And that's what we're doing. So in real life, when variance is there, you get right skewed distributions of results, meaning a higher chance of underperformance and a lower chance of a big overperformance. And that's what's illustrated here. So what we see in real life are geometrical returns. That's returns of exponential growth over time. And these geometrical returns will average, will have a different average than what we intuitively think. So when we see this game here, we are playing coin flip, and if we get heads, we win 50%. If we get tails, we lose 33%. So we think we bet 100 kroner. If we win, we win 50. If we lose 33.3. And that then we can divide that by 2, and we would say that we get an estimated return of 8.3%. And that is correct when we make that game that way. But our portfolios, once we had a good return, we invest the entire portfolio again. That's how our portfolios travel through life. So if we win the first time, we have $150. And then if we lose the next time, we lose a third of that. And that means that we have $100 again. So the average geometric return when we travel through time is 0% return. And this illustrates it here. You have the arithmetic return here, and then you have the geometric returns here in a simulation where you can see them averaging out around 0%. Let's try to decrease the ups and downs in this game. So we say that instead of winning 50%, you can only win 40%. Instead of losing 33, you can only lose 23%. You still have the same arithmetic return, but your geometric return, it just increased. So the less variance you have on a result, the better the geometric return you get, the mean return, real life return you are likely to get. If you instead increase the variance up 60, down 43%, same arithmetic return, but the geometric return just deteriorated to negative. That is the problem with growth and tech stocks, and that is why growth and tech stocks has to be undervalued. So non-ergodicity, the last concept, and it's the entire problem, sort of named in a theoretical context. The term ergodicity was coined by Ludwig Boltzmann, one of the pioneers of thermodynamics, and he made the laws for some of the laws for statistical mechanics. And he predicted that there would be some systems that where you could not apply average values to all situations. And then it has sort of disappeared from the thinking, and then pops up every 30, 40 years, being reinvented. And the beacon of today for non-ergodicity, or for ergodicity economic thinking, is Ole Peters. He's a German physicist working at the London Mathematical Laboratory now. And he's inspired us a lot in the creation of the solutions for this problem. What non-ergodicity is about is when these two averages does not match, when the arithmetic return is not the same as the geometric return, then the system is non-ergodic. And the problem is, like I talked about, that there are some extreme results that kind of distorts the median result from the average result. So what can we do about it? There are some low-hanging fruits. This is Hendrik Bessenbinder with the study. He studied all stock results from 1926 to 2016. That's 3.6 million monthly stock returns. And he made some simulations. We have seen one. This is another simulation where he draws from these monthly stock returns and then creates portfolios, a 1-stock portfolio, 5-stock, 25, 50, 100 stock portfolio. And with a 1-year time horizon, we see that the median result is improved once we diversify the portfolio more. A fun thing that we see is that the 1-year expected return when you have 1.13% per month is actually 14%. And we know that the stock market yields about 7%. So there is a discrepancy here. And that's actually the difference between the geometric return and the arithmetic return. The arithmetic return of the stock market is 10%. So if we just calculate what are the returns of all stocks, that would result in us thinking that we would get a return of 10%. But companies are growing exponentially with a variance on their growth, and thus the returns becomes less because of the variance drag. So the geometric return, which is the return that we experience in one life, is 7%, and that's what we know as the stock market return over long term. In this figure, we also see that if we have a 100 stock portfolio, we are very close to the index geometric return. If we have a 25 stock portfolio, things start to deteriorate. We actually will have a median return which is somewhat lower, and if we go to 10 stocks, it gets really bad. So let's look at the tech indexes. We had the Bessemer Venture Partners Cloud Index, and that yielded 22%. So I put in the line here, which is the Bessemer Venture Partners Index. So what I'm postulating here is that if you take the Bessemer Venture Partner Cloud Index stocks and you put those into a 20-30 stock portfolio and do not think about the effect of variance or anything, you would likely get a median result that averages the market result. That would be somewhere around 6 to 7% result because of the variance drag that would be very high on that portfolio due to the high variance of these stocks. But once you have them in an index, like our portfolios, you'll get rid of a large part of the variance drag. But there is something that is even more appealing, and that is that if we could remove this effect here between these two, because this is a theoretical arithmetic return from the Bessemer Venture Partner Cloud Index. That could be maybe around 30. I haven't done the math. This is just me guessing that it would lie somewhere up there. And the process would be the same, like taking the stock indices and trying to mitigate the effect here, and trying to increase the returns even more. And that's actually what we're doing in the NewDeal Invest Layer 2 solution. We are working on approximating the geometric return to the linear arithmetic return in order to improve the index performance even more. How we do this is not something that we share. I feel that once you dig into this, it's not very complicated. One of the things that you really need to be able to estimate is the variance of these companies, and that implies that you need to have an understanding of tech, where the world is heading. So we kind of have the toolbox inherent in our group here to work with this process here. So in summary, in summary, tech and growth outperforms as an index, but not in a concentrated portfolio of less than 30 stocks. NewDeal Invest Layer 1 is creating an index of best of breed tech companies. The NewDeal Invest Layer 2 is increasing the median performance of the index. We're trying to get closer to the arithmetic return, to the theoretic return of the index, by optimizing and mitigating the effects of variance. We have 3 platforms that you can invest in. We have the main fund, which is the alternative investment fund with a minimum investment of 100,000 euro. Then we have the Nasdaq listed UCITS fund with the ticker code PMI NDI. the ISIN code DK0062499810. And then we have the eToro trading platform, where we have our smart portfolio called NDI Future Tech. You can find us at our webpage, newdealinvest.dk. We have a newsletter. We are at Facebook, Twitter, LinkedIn, and YouTube. And then on the eToro platform, Smart Portfolios /NDE Future Tech. And at YouTube, do subscribe to our channel. We'll be doing live events where you can ask us anything, where we'll be discussing topics that are actual. So come and do ask questions there. And then all I want to say is thank you for listening, and do reach out to us and ask any questions that you might have.